Have you ever felt like you're missing something when it comes to real estate investing? Like there's some hidden code that the wealthy seem to know, but you don't? Well, my friends, you're not alone. And the chances are it's because of these 12 fundamental concepts that investors oftentimes get wrong. Real estate is one of the most powerful and lucrative wealth building strategies that people have used over years, over decades to create massive fortunes. But on the flip side, for every success story that there is in real estate, there's probably 2, 3, 4, or 10 times more horror stories. So understanding how to be successful in real estate is critically important because your success and your failure is magnified if you get these things wrong. So in this video, I'm going to share with you the things that you must understand if you want to grow your wealth in real estate and avoid devastating mistakes. By the end of this video, you're going to understand not only what these concepts are, but how mastering them can completely change your financial game. So my friends, let's dive into what the pros know and what the rest overlook. Hey there, my name is Ryan Lee, and today we're going to be breaking down the 12 key concepts that every real estate investor has to know. If you're like most investors, you may have heard of the terms like compound interest, inflation, risk and reward, but let's face it, knowing the words, it's not enough. Today we're going to be breaking down exactly what they mean and how they impact your wealth and how you can't afford to get them wrong. Now my friends, I've made a lot of money. I've made multiple 7 figures in real estate. I've also lost multiple 7 figures in real estate. And so a lot of the lessons that I've learned, I'll be honest with you, I've learned them the hard way. But after learning from the losses, I've built and developed a system now that I've been using for over a decade to create consistent and predictable wealth inside of real estate using these terms. So whether you're just getting started or you're a seasoned pro, this video is going to show you how to start making smarter decisions and put more money in your bank account. So let's get into it. So concept number 1 is compound interest. Most people think of compound interest as something that just happens over time. And it is something that happens over time, but here's the reality. Compound interest is either something that time benefits or time is working against it. Listen, the reality of it is most people start their investing journey too late for compound interest to really take an effect. I mean, think about this. If you're in your late 40s or your early 50s trying to save for a retirement at 65, you're working against time. You're trying to build up as much wealth as you can in 10, maybe 15 years so you can drain it down over the next 20, 30 years of your retirement. If you really want to harness the power of compound interest, you have to get in the mindset of buying an asset and holding that asset. Now, this is one of the reasons I love real estate. You can buy an asset and let it compound over a long period of time, but at the same time, you can distribute a stream of income out of that asset without diminishing its compound growth. So it's important to understand in compound interest to acquire assets that give you multiple profit centers, multiple ways to make money. That way you can experience the compound benefits of holding an asset for a long time and the benefits of generating a stream of income from the very same assets. This brings me to concept number 2, my friends, inflation. Now the misunderstanding here is people think that inflation just means higher prices at the store, but it's far more destructive than that if you don't understand it. Inflation erodes the purchasing power of every dollar that you hold. This means that every year, the money in your savings account is worth less and less. But as a real estate investor, you understand that inflation can actually work for you. I want you to consider this really quick. Inflation is a universal truth. We all live in the same world, therefore we all experience the same economic forces. The question that you have to ask yourself is, are these economic forces working for you or are they working against you? The biggest challenge with inflation is working against most investors. When you put your money in an account like a 401k, your returns have to outpace inflation, taxes, and the cost of being in the market. But when you put your money in an asset like real estate, inflation is actually making you money. I want you to consider this. When you use debt and inflation together, you get a fixed interest rate mortgage, meaning you're paying the bank back over 10, 20, 30 years with less and less valuable dollars. But at the same time, you're holding an asset that the purchase price, the value of that asset is going up every single year along with your income because you get to raise rents slowly, incrementally as the cost of living is going up. So you hold an asset that is making you money because of inflation and you're paying back a liability on that asset with less and less valuable dollars over time. Inflation is either hurting you or it's helping you. It's working for you or it's working against you. This brings me to concept number 3, risk versus reward. Most people believe and have an erroneous misunderstanding here that higher risk equals higher reward. My friends, over a long enough period of time, that never works. The reality is just because an investment is risky doesn't mean it's going to give you a higher return. In fact, it has a higher probability of taking all of your money off the table. But the reality of having an asset or investing in an asset that has multiple profit centers, you can actually get a higher return, but take less risk in the same time. Think about it this way. One of the reasons I love real estate is the fact that I can own an asset and I make money in 4 separate ways within that asset. Here's how it works. If you own real estate, your real estate is going up in value, appreciation. At the same time, if I bought real estate as an investor, I'm getting a positive stream of cash flow. Cash flow is my second profit center. The third profit center that I have is I'm getting massive tax advantages. I'm not gonna go into the details of those on this video, but that is for sure a return. And the fourth most powerful return that I'm getting is leverage. 4 returns in one asset. Now here's how it increases my return but decreases my risk. If one of those profit centers goes away or pauses for a period of time, like my tenant stops paying me rent for a couple of months, that sucks. But I'm just gonna sit back and let my real estate go up in value. Or if the real estate goes down in value over a short period of time, I'll just sit back and collect my rent checks. My friends, it's important that you understand that there are 4 pillars in investing. And if you choose wisely and focus your investments on the assets that have all 4 pillars, you can actually get a higher return, but take less risk, which is the exact opposite of what most people do in things like the stock market. Concept number 4 is good debt versus bad debt. Listen, most people believe debt is bad, but I want you to consider this. If you looked up Robert Kiyosaki right now, Robert Kiyosaki, the author of Rich Dad Poor Dad, is bragging about his $1.2 billion in debt. Now, why would this individual be bragging about being $1.2 billion in debt? Well, Robert Kiyosaki, like all good real estate investors, understands something that most people don't, and it's that debt is money. I want you to consider this, my friends, because the fact that Robert Kiyosaki has $1.2 billion in debt, that means a bank gave him $1.2 billion. Now, the difference between good debt and bad debt is Robert Kiyosaki didn't use $1.2 billion to go buy mansions and cars and shoes. No. Robert Kiyosaki used $1.2 billion to buy a profit center, a portfolio of real estate that's multiple values higher than the debt that he took out. Let's just imagine he's in a 50% debt profile. What that means is that $1.2 billion is backed up by a $2.4 billion real estate portfolio. Robert Kiyosaki understands the power of good debt and using good debt to buy real assets that put money in your pocket. This brings me to concept number 5, which is asset liquidity. Most people misunderstand this. They think if they own an asset, they can easily convert it into cash whenever they need it. Now, my friends, it is critically important if you're gonna get into the game of investing that you balance out your investment kind of like a barbell. Think about taking risk on one side through investing and having massive amounts of liquidity on the other side. Your barbell has to be balanced, otherwise you're gonna get injured. And this is the same with real estate investing. If you're going to use leverage in the game of real estate investing, your permission slip to use that leverage is liquidity. You have to balance out your liquidity because the only way you lose in the game of real estate is if you get knocked out of the game of real estate. And the way most investors get knocked out is they get into a cash flow crunch, a liquidity crisis. They've used leverage, something goes wrong with the investment, they need a little bit of influx of cash to make it through the down period of that investment, and because they're not liquid, they have to flip the investment, lose money, and sometimes declare bankruptcy. This brings me now to concept number 6, which is diversification. Most people believe diversification is the holy grail. It's the way to protect them from all losses. I want you to consider this. Diversification is not what it's cracked up to be. Warren Buffett actually said diversification is only relevant for those people who don't know what they're doing. Diversification is really important if you're going to put your money in assets that you don't control and you keep your financial IQ low. But I know something about you watching this video right now. You are increasing your financial IQ at this very moment, which ultimately means in order for you to use your higher financial IQ to build real wealth, you have to put aside the concept of diversification and double down on focus. Get rich in a niche. The faster you can focus and develop an expertise, the faster you can make money. That goes with your profession, the same with your investments. Double down and focus, then protect your profits in a diversified way. That's why I love the passive income machine. I like to focus on real estate and protect my profits with high cash value life insurance over and over and over again. This brings me to concept number 7, which is taxes and tax brackets. My friends, taxes is the most misunderstood part of creating wealth. And most people think if they earn more, all their income is going to be taxed at a higher rate. This is only relevant if you misunderstand the tax code. Listen, tax brackets are progressive on earned income, meaning the more money you make, yes, the more money you're going to pay in taxes. But earned income is not the only form of income. You can actually have other forms of income as well. passive income, investment income, dividend distribution. There's lots of different ways to take income, and each different way that you take income will determine which tax code you're actually being taxed by. My friends, in Robert Kiyosaki's book, The Cash Flow Quadrant, he talked about earned income, self-employment income, business income, and investment income. And what he actually opened up inside of that book, when you take your income from the investment income, you're using the tax code to your advantage, and you legitimately can take income without paying any taxes. I want you to consider this. How much easier would it be for you to achieve financial freedom if your income was not taxed? Ultimately, what this means, if you just mastered the game of taxes, you'd be 30 to 40% closer to your goal of financial freedom because you wouldn't need as much income to generate the lifestyle that you want. Because if all of your income is spendable, if none of it's taxable, you're that much closer. My friends, raise your financial IQ in taxes. This is the most critical thing you can do as an investor dedicated to financial freedom. This brings me to concept number 8, opportunity cost. The reality of opportunity cost is it's what you give up when you make one choice over another. Every dollar you invest in one location, the opportunity cost is what could that dollar have been doing elsewhere had you not put it in the previous location. I want you to consider why this is so important. You have limited dollars. Now, I don't want that to constrain you. I want you to get as many dollars in your economy as you possibly can. But once you have a dollar in your possession, it is critically important that you understand what you want the outcome of that dollar to give you. What do you want your money to do for you? I have to imagine if you're on this channel, you want to be financially free. And every dollar that you put into a tax-deferred investment, like a 401k, you've now suffered the opportunity cost of that money could have been working multiple times harder for you inside of a system called the passive income machine. What if you could use leverage on your money? What if you could have tax advantages on your money? What if you could have a stream of cash flow on your money? Every dollar that you park in a 401k, even if you're getting the company-sponsored match, the opportunity cost is what it could have been doing elsewhere. This is one of the critical, important things that I talk to people about, and it brings me back to the earlier concept I gave you of diversification versus focus. If you focus your dollars, you're going to get focused outcomes in a focused period of time. This brings me to concept number 9, which is the time value of money. Most people believe that a dollar today is worth the same dollar in the future. But the reality of this is money today is worth more than the same amount in the future because two powerful forces of compounding growth, which we've talked about, and inflation. Let's illustrate this with a powerful example of compounding. Imagine person A starts saving $10,000 per year from the age of 20 all the way to the age of 30. Then person A stops. They stop their saving and they let their money grow until the age of 65. Meanwhile, person B waits until the age of 30 to start saving and then saves $10,000 per year until the age of 65. Assuming both people, person A and person B, are getting an annual return of 7%, person A's initial investment of $100,000 grows to nearly $1.1 million by the age of 65. But for person B, who started just 10 years later, they would have to save every single year from age 30 to age 65, saving almost $350,000 just to reach the same amount. This difference is the power of compounding. The earlier you start, the more your money can grow on itself, giving you an incredible financial advantage. Inflation is the other piece of this equation. Every year, inflation is eroding the purchasing power of your dollar, meaning that $100 today might only be worth $74 10 years from now at a 3% inflation rate. Together, compounding and inflation show why saving and investing as early as possible are crucial steps towards financial freedom. This brings me to concept number 10, credit scores. Most people believe that carrying a balance on their credit card actually helps them build credit, but I want you to understand this. The reality is when you pay off your credit card in full, it's always better. It actually builds a better credit score. It shows that you can manage your credit effectively. Now, I want you to understand this. Credit is the key for you to accessing leverage. We've already discussed the power of leverage, so manage your credit scores effectively and keep them as high as possible. This brings me to concept number 11. Concept number 11 is that of leverage. Most people believe that leverage is the fast track to wealth. Now, here's the reality. Leverage is the fast track to wealth, but it only can be used with a high financial IQ. Leverage can absolutely accelerate wealth building, but it's a double-edged sword that amplifies both gains and losses. For every success story, there's just as many cautionary tales, often because leverage was used recklessly or without a full understanding of all of the risks. Leverage, when used wisely, can be powerful, allowing you to control larger assets and turn every dollar that you invest into multiple dollars. My friends, it's critically important that you understand leverage and you deploy it responsibly. And remember that barbell. For every dollar of leverage that you're using, make sure you're offsetting that leverage with the appropriate amounts of liquidity. This brings me to concept number 12, which is the purpose of money. Now, We've talked all about investing in this video, and I want you to understand how critically important investing is. But if you're a goal-driven individual, a lot like me, you lose track of the real purpose of money. You'll realize the further you chase your goals, you'll always realize that there's more to achieve, that you can do more, have more, be more, and accomplish more. Now, this is a wonderful mentality to have, and I do not want you to lose it. But I want you to balance that mentality with the understanding that money is a tool to build and live a life that matters. And my secret for investing better is to offset a portion of your dollars to things that give you real meaning and real value today. The better you can live and experience financial freedom today, the more meaning your investments actually have, the more motivation you find to stay committed to growing a long-term portfolio that will build more and more levels of financial freedom. But the key is balancing out the ability to both pursue financial goals and live fully in the present moment. For every goal that you're pursuing, make sure that you're offsetting that goal with rewards that help you understand what money is for inside of your life. So my friends, which of these concepts were new to you? And which do you already feel confident about? Drop me a comment below and tell me what you're working on inside of your financial plan. Now, if you haven't done so yet, click that subscribe button, and my friends, I'll see you on the next video.